So here's a great book summary about the Warren Buffett way, right? So a book is written by Robert G. Handstrom, right? So I will start with the introduction. The Warren Buffett Way, by Robert G. Handstrom, explores the investment philosophy and strategies of Warren Buffett, one of the most successful investors in history. The book provides insights into So here, the Warren Buffett Way by Robert G. Handstrom, explores the investment philosophy and strategies of Warren Buffett, one of the most successful investors in history. The book here provides insights into how Buffett, selects stocks, manages, risk, and build long-term wealth. The abridged here, version, distills how principles into key lessons, that can be applied by investors of all levels. Okay, the part one here, Warren Buffett's investment philosophy, right? Buffett's background and influences. Right here, Buffett's background and influences. Right, Buffett's investing journey was totally shaped by two key mentors, Benjamin Graham and Philip Fisher. Right, first is Benjamin Graham. Okay, author the Intelligence of Investor. Right, Graham introduces Buffett to value investing, emphasizing buying stocks below their intrinsic value. Right. Okay, here Philip Fisher. Philip Fisher is Fisher's common stocks and uncommon profits taught here Buffett the importance of investing in high quality companies with strong management and sustainable competition advantages. Right, Buffett combines these two approaches here, Graham's deep value investing and Fisher's focus on quality business to develop his unique investment philosophy. Right, key principles here, if I'm talking about the key principles of Buffett's investment approach, then the point is that Buffett follows a set of fundamental principles when selecting investments. First is think like a business owner. You have to think like a business owner, right? Buffett views stocks as ownership in a business, not just a ticker symbols. He focuses on long-term business fundamentals rather than short-term market fluctuations. Buy business, not stocks. Buy businesses, not stocks. He prioritizes companies with strong brands, competitive advantages and consistent earning. Buffett's investments in companies like Coca-Cola and American Express reflect his preferences for businesses with durable moats. Right? Okay, invest with margin or safety. So margin of safety. I mean to say, invest with a margin with a safety. Right? Inspired by Graham here, but Buffett only buy stocks when they trading below their intrinsic value. Right? This approach minimizes risk and increases the potential for strong returns. Point 4 here, focus on long-term growth. Buffett avoids market speculation and short-term trading. His strategy involves holding an investment for decades, allowing compounding to work in his favor. Quality over quantity, right? Quality over quantity. He preferences concentrated investment in a few high-quality stocks rather than spreading capital across many mediocre businesses. Right? This is evident in his long-term holding companies like Apple, which has been a key driver of Berkshire Hathaway's success. So part 2 is a Warren Buffett portfolio. Section of companies here Warren Buffett looks for the following traits when selecting investments. Here, strong management. If I'm talking about the strong management, he invests in companies run by competent honor leaders, consistent earnings. If I'm talking about this, then he prefers businesses with a predictable and stable earning growth. Right, he returns on equity, ROE. Companies with a strong ROE indicate efficient capital use, low debt levels. Here Buffett avoids highly leveraged companies, and excessive debt increases risk. Major investment and case studies. Right, okay, there are major investments and case studies. The book highlights several of Buffett's iconic investment and rational behind them. Coca-Cola, here Buffett invested in Coca-Cola in the late 1980s, when the company had strong global brand recognition and consistent revenue growth. Here, American Express, here Buffett showed value in American Express, even during its financial struggles, in 1960s, believing in its long-term potential. Here, GEICO, right? He recognized the power of GEICO's, direct insurance here business model and gradually acquired the company. Here, Apple, although Buffett historically, avoided technology stocks, he invested in Apple due to its strong brand loyalty and financial strength. Each case study demonstrate Buffett's ability to identify long-term winners and ignore short-term market noise. The importance of economic moats. Okay, Buffett seeks here business with economic moats, or sustainable competition advantages, which help companies maintain their market dominance. This include here, brand loyalty, example Coca-Cola and Apple. Right, cost advantage, for example, GEICO's low-cost insurance model. Right, okay, network effects, network effect here, example American Express and Visa. Regularity, what is that? Regulatory protections example here, utility companies, companies with strong moats can sustain profits and fend off competitions, making them ideal long-term investments. Part 3 is Buffett's investment strategies and psychology. Contrarian investing here. Buffett often buys stocks when they are out of favors. He believes in being fearful when others are greedy, and greedy when others are fearful. Example here. The example includes buying American Express during its financial scandal in 1960s, investing in Bank of America during 2000 and 2008 financial crisis. Patience and discipline here. The most important part is patience and discipline here. Okay. Buffett's success is Buffett's success is driven by patience. He waits for the right opportunity and does not chase short-term market trends. His long-term perspective allows him to benefit from compounding. Avoiding common investment mistakes. Buffett avoids market timing. He does not try to predict short-term market movement. Here over diversification. Instead of owning hundreds of stocks, he focuses on a few great businesses. Speculation. He does not invest in companies without clear fundamentals. If you don't have the clear fundamentals, you don't have to invest in any companies with expectation or speculation, right? Because if you don't understand the fundamentals, what it is, so and then after onward, if you are totally trying to invest in the companies, right, then you are in illusion that you will get that profit. You will be lost, might be possible, because you will not understand the instincts of the fundamentals of that particular company. So if you're not understanding the fundamentals, how could you invest your funds in it? If you're tracing that money, you will be lost. So yeah, the power of compounding here. Buffett's fortune is largely the result of compounding over many decades. He invests earnings to generate exponential growth, showing that time is the most powerful force in investing. Conclusion here. Okay, here the conclusion. Lesson from Buffett. The book summary takeaways from Buffett's approach. Invest in business, not stocks. Okay, look for strong competitive advantages that go the moats, MOATS. Right, look for strong competitive advantages. Buy with a margin of safety. Be patient and think long term. You have to have kind of patience, and if you don't have the long term thinking ability, you are end. Okay, ignore market noise and focus on fundamentals, right? Okay, let compounding work in your favor, right? Okay, so here the Warren Buffett, a fascinating deep dive into Buffett's genius by Robert G. Handstrong. Okay, imagine turning a modest sum into billions, not through luck or shortcut, but by following a disciplined and deeply insightful, investment strategy. This is the essence of the Warren Buffett Way, a book that unlocks the secret of the world's greatest investors. Warren Buffett's success is not about stock market, wizardry. It's about patience, intelligence, and seeing opportunities where others see chance. Okay, let's embark on a journey through Buffett's investment genius and discover how he built one of the greatest financial empire in history, right? Okay, chapter 1 is the making of a leader. Before Warren Buffett became the oracle of Omaha, he was young boy obsessed with numbers, business, and market and money making. He bought his first stock at the age of 11, and by 16 he had already saved thousands of dollars through various ventures. But Buffett's true transformations came when he met two extraordinary mentors, right? First is Benjamin Graham and Philip Fisher, as we know about fact, right? So these are the points which is so important in our life to focus on, right? As you know, the regulatory protection, here cost leadership, network effects, brand power. What is brand power? They are the four key types of economic modes, as I said already, I think. Okay, the brand power here, companies like Coca-Cola and Apple have strong brand loyalty, making it difficult for competitors to steal customers here. Second point is cost leadership here. Buffett loves businesses like Geico, right? GEICO, what you call, right? Okay, Geico, right? Okay, which keeps costs lower than competitors and dominate the market. Network effect, regularity protection, right? So these are the example here, right? So what I have to add more? So how Warren Buffett stays ahead while others fail, right? Warren Buffett's success is not just about what he does, it's about what he avoids, right? Mistakes Buffett never makes. He does not follow the market hype. He never follows the market hype. He skipped the .com bubble in the 2000s, avoiding massive losses. He does not time the market, right? Okay, instead of predicting market crashes, he buys when others are panicking. He does not over diversify. He does not over diversify as well. While many investors own hundreds of stocks, Buffett, concentrated, his money in handful of high quality businesses. The disciplined approach has made, Warren Buffett virtually, recession proof, right? So these are the points here. What I have to add more for you guys. Chapter 6, that the power of compounding. I think, I have already cleared the power of compounding. Buffett's greatest secret, Buffett's fortune was not built overnight. The true magic of his wealth comes from, compounding, the process of investing profits over time. Okay. Example of Warren Buffett's compounding genius. At 30 years old, Buffett was worth about $1 million. Right, if by 50 years old he was around $300 million, right? By 90s his fortune had grown to over $100 billion. So Buffett often says here, time is a friend, is a wonderful business, the enemy of the mediocre. This means that this means that if you invest in great companies and wait. So this means that if you invest in great companies and wait, wealth will grow exponentially, right? Okay, lesson 7 here. We can all learn from Buffett. Buffett investment strategies are not just for beginners. They can be applied by anyone. Buffett five key takeaways. Think long term, right? Don't chase quick gains here. Focus on business that will last for decades. Ignore market noise. Daily stock prices. Don't matter. Daily stock prices don't matter. Business fundamentals do. Be patient here. The best returns come to those who wait. Right. Avoid unnecessary risk. Only invest in what you understand. Right. Okay. Let compounding work its magic. Okay. Start early and reinvest for maximum growth. And the conclusion of the point is, becoming an investor like Buffett. What you have to do. So if you want to be an investor like Warren Buffett, so what you have to do, Warren Buffett's path to billionaires, is not about being a genius. It's about to be a disciplined, rational, and patient. Like, he does not gamble. He was not a gambler. He does not follow the crowd. He never, follows the crowd. Okay. He does not chase trends. So what are the trending topics? We are so curious to know. So what are the trending topics of the film? What are the, if it is about the film or particular news, whatever it is, we are just chasing the trends. What are the trends? What is the trending point is happening? What is the trending things is happening on Instagram, YouTube, wherever, just doing Twitter, right? We are chasing the trends. Buffett never chased the trend. He totally stick with his own instincts. Whatever his instincts are, and whatever I have already cleared here, that was his instincts. So he was focused on instincts, right? So that was his instincts. He never chased the trends. Instead, he sticks to proven a strategy that anyone can learn and apply, right? By following Buffett's principles, anyone here, whether a beginner investor or seasoned professional, can build lasting wealth. So the real question is, will you invest the Warren Buffett ways? Will you invest the Warren Buffett ways? Comment me now. So yeah, bye.